Yeah, well, the capital flow position has stabilised a bit, and I think the credibility of the central bank in China has been enhanced. They've not been doing so many erratic things. We're still concerned about China in the medium term. The reason that they can continue to oil the wheels and the reason that it's unlikely to roll over in an unceremonious fashion is because they've got a very large current account surplus. So that can continue to delay the day of reckoning. But ultimately, there is still capital flowing out of the country, masked through trade flows. The lurch back to infrastructure spend, by implication, can only be a temporary push, and the evergreening of non-performing loans as well can't go on forever. So we think they've kicked the can further down the road, but it's still, the day of reckoning is, will still come through at some point in the next few years. Yeah, and I think that's a critical point. The more the dollar rises relative to the renminbi, the more costly it is for the Chinese to maintain the currency peg. So that's where things can start to unravel. And if we started to see interest rates come through in the US much more significantly than is expected at the moment, it then gets very, very costly for China to maintain that peg, and that's where things could start to unravel. Well, we benefited hugely from emerging market exposure. I mean, what we saw in the aftermath of the Brexit vote was a lurch away from sort of West and Europe and a move into emerging markets, and there've been stellar returns since then. It can be quantified in the back of flows. It can be quantified in the back of interest rates being pushed out, interest rate increases in the US being pushed out. We know that when interest rates rise in the US, that's usually a negative for emerging markets. So we can understand why it's happened, but we think it's overblown. So we started to reduce our exposure to emerging markets quite significantly, having been positioned quite well there.